Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. All the comments, subscribers, I greatly appreciate it. This week up, we're going to finish out our series, Lululemon versus Under Armour. This week up, Under Armour. Let's take a look at this stock. Let's figure out how much cash money it makes. And if we hold the stock for 10 years, how much can we make by owning the stock? Ready? Let's get to work. We're going to evaluate the stock like we do with all of our stocks on the 5 key attributes. We're going to, number 1, top line revenue growth. It must be growing revenue. Number 2, earnings growth. I want to see EBITDA growing. Number 3, strong free cash flow, obviously. Number 4, low debt. Number 5, well-priced. What is a well-priced stock? A well-priced stock is a stock with a conservative forecast that can beat the market. That's what we're looking for. Okay, behind me is the 10K for Under Armour. We're going to rip through this thing, take a look at their financials. I want to stress to everybody, please read the 10K as any stock you're considering to invest in. Also, I really want you to read the 10K every single year for any stock you own. What that's going to do is going to limit the number of stocks you're going to own. You have to focus your ideas, get you to really pay attention to where you put your money. Okay, behind me is Under Armour. Let me give myself a little bit more room. Under Armour, fiscal year ends December 31st. I've got revenue here in millions of dollars USD. One note here, you've got 2 different classes of share, Under Armour UAA and Under Armour UA. That's just breaking up the ownership class of shares. I'm adding both share classes together to get a full picture of the enterprise value of the business. Which I can teach you how to do that in my cash flow course. We'll talk later on about that. Okay, revenue. 2013, let me move this up a bit. 2013, $2.3 billion of Jack made in revenue. I like that. That has grown from 2013, $2.3 billion to $5.6 billion with a noticeable stumble here for COVID. They had a disastrous COVID with their store closures. They made a lot of big bets that failed. They stumbled. Now the CEO is stepping down. They're kind of retooling. Even next year is estimated to be a down year again. So the stock's definitely having a little bit of turmoil. As a result, the stock price is down itself. Let's figure out where it was, where it might go. This is gonna be a fun one. Let's check this out. So here we go. $2.3 billion has grown prior to that actually pretty steadily. 3 billion, 3.9, 4.8, 4.9, 5.1, 5.2. Kind of slowing down in here a little bit, but I do like the growth. And then they're projected to rebound even if this next year is going to be a little slight. Everyone's saying long term, they think this company has a lot of room to grow. I kind of agree. $3 billion in EBITDA, $316 billion EBITDA, 426, 562. That's nice and growing. Got a little stumble in here, negative. That's a little patchy, to be honest. That's a little patchy. Long term, however, because we are long-term stock buyers, you should not be buying a company if you're not going to own it for 5 or 10 years. Don't buy it. Long term, however, 9% annual growth rate for EBITDA, 12% annual growth rate CAGR for revenue. So that definitely checks the boxes, even though there's a little bit of stumble there. I think that increases the risk profile for me a little bit. But it's still growing. Let's check out enterprise value. Enterprise value starts with debt. We got short-term and long-term debt here of basically zero. That's $53 million. It's not much for a company like this size. And that has grown to $663 billion over time. So that's not great, but it is what it is. Market cap, shares outstanding times price. And I've got no excess cash here. Interesting, look at this. So the market cap of $9 billion has come back to market cap of $9 billion. A full cycle. That's bubble territory in my opinion. So back in the day, it looks like he was growing substantially and then absolutely cratered. You've got a full round trip in the stock. Interesting. Enterprise value is market cap plus debt, less cash. Same thing here, $10 billion to $10 billion over the time. Let's do debt. Let's cover the debt first. Net debt is close to 1. It's as low as 0. been high actually when earnings were dipping down. The back half of that period, I said, was slowing down. It looks like the debt levels were really, really growing. Then they kind of got those under control, bought down the debt, earnings recovered, and it normalized, which was nice. But this is why we look at debt. I want to know, like, if you have 4.6 times leverage, that's above our benchmark. That's a concern. And certainly the last 3 years in a row leading up to that, it had been growing. Really nice to see the company take action, realize that's too high, focus on getting it down. Looks like they got it under control, and then the pandemic hit they got it under control right before the pandemic. So they were in a good spot going into the pandemic. And again, that's the important of looking at the level of debt that a business has when pandemics strike. Negative earnings happen. It's very critical that you have very little debt, lots of cash on hand. So that checks the box right now. They're sitting at 1.1. That's good. Enterprise value to EBITDA, right? Our market multiple approach. Enterprise value is the entire enterprise of the business. Divide that by the earnings. In our case, EBITDA. Annual EBITDA is like the stabilized kind of run rate of the business. It's not trying to be cash flow. It's just trying to estimate the income statement on an earnings basis for the core business. That's what EBITDA is trying to do. And look at the premiums we have here. Wow, 30 times earnings. Back in the day. That grew to 50 times, 55 times, and then absolutely cratered. Look at that market multiple collapse. That's a halving in the market multiple, which is a halving in the stock price. Then on top of that, depending on earnings due, if earnings went down or went up that particular year, right? In this instance, actually earnings rebounded. So what this is doing is this is super high because this number is too low, and the market expected this 157 to come back up. So they're kind of normalizing it. So it's probably trading at this rate on average. That's kind of what it looks like actually to me. This popped up because EBITDA came down. On average, they're saying, hey, this is a 25 to 30 times market multiple stock over time. Right now, it's sitting at 19 times, which is very interesting. Excuse me, 16.9 times. All right, so that's the revenue, EBITDA, enterprise value, a couple ratios. Let's move forward and check out free cash flow. Okay, free cash flow per share. 2013, $120 billion. That looks to be very similar to the number actually that Lululemon had. 2021, $665 million of free cash flow. I think Lululemon was $800 million. Good job, Lulu. 665. That's been growing nicely over time, 24%. Really strong move. That's stronger than the EBITDA, but it's still directionally correct, which is what we want. We want to see positive and positive, or negative and negative, not positive and negative. It's the difference ones that you want to be careful about. CAPEX seems to be very low, in my opinion. So these are strong numbers. Let's just recover cash flow from operation. Cash flow from operation is the first third of the balance sheet, right? Cash flow statement. You've got cash flow from operations. Cash flow investing is the middle section. Cash flow from financing. So this is how much cash do they make running their business, selling t-shirts, selling the footwear. This is cash, pure cash money. Then in the middle section, cash flow investing. That's the cash that they put to work for CAPEX, for buying other companies, acquisitions. What are they investing in? And then financing section, do they pay a dividend? Do they buy back shares? Do they issue shares? Did they pay off debt? Did they borrow money? That's how they finance the business. So we want to pick up the first third, cash flow from operation. How much pure cash money, Jack, did they make from running their business? And in this instance, last year, they made $665 billion of cash running their business. What do they have to do with that money, right? So they have to put some of the money back in the business for CAPEX. CAPEX is the reinvestment of cash flow into the business to keep the ball rolling. Paint to the windows, new computers, ERP systems, expanding production lines, all that stuff is CAPEX. What I'm noticing here, look at this. So what they did is they stumbled, right? So they stumbled earnings here. Bad time. And what they did is they cut back on CAPEX. Look at this. So here's the run rate. Look at the spread between cash flow from operations, 237 versus 208. That's almost 100% by this, more than 100%. Then the next year it comes down, fine. So this is probably too high. But here, these numbers are a lot higher than these numbers. See how they cut the CAPEX down over the last several years? They're under investing in their business. That's what that means. That's them under investing to save cash, to boost earnings, to pass through to get a stock price to rise. And that's not something that's sustainable. In order for the business to continue to run, they're going to have to put money into the business. So going forward, we're not going to take this. This is saying they made $665 billion of cash. They only put $70 billion back in. Let's ignore debt. That means this coming through should be about $600 million. Here it says 87 because of debt, but $600 million is way too high for this business because historically they were putting $100 to $200 million back in the business every single year. Here, they're under 100. So what I'm going to have to do, and what you should know, this is why you can't use stock screening when you create value. You must read and look at the data yourself, is this number is way too low. This number needs to be, what? I averaged, I'll cut to the chase. I averaged this versus this, it's 58%. So 58% of their, 58? Now I'm questioning myself. 52. I cheated. All right, so 52% of cash flow is being put back into CAPEX in this period of time. That's what I'm going to do. So this number here should be close to $300 million. They're under investing. So this free cash flow line is going to be too rosy. Going forward, we're going to take this, we're going to grow it, and we're going to take off 52% of it because that's the money they should be putting back in their business. If they're not, that's a problem. Debt issuance, you saw that they paid down debt. These are largely negative. Last couple of years they paid down debt. I want to see that. That does make challenging the cash flow per share a little bit because this number here is understated, right? This should be about 300 million, assuming they didn't have to pay the debt down, move that because it's one-time deal. You resize this to 300. That means that this number should be about 350. Divide by share, you should be in the sub $1 range, not 19 cents on a normalized basis. But this is what the math is. You also want to say that they are actually issuing shares. That kind of makes sense to me. If their cash that they're generating isn't great, they're cutting back on CAPEX for a particular reason. That seems to me like they're issuing shares is a legitimate reason. Now, I don't like it. I want to see them buying back shares, but I'm just trying to say that it's understandable why they're doing it. Price per share has come down a lot, 40 to 21. So actually losing money over time. Free cash flow per share is actually okay. If you look, let's zero out the debt and let's see what this looks like. So if we take debt and just move debt to zero for the time being, free cash flow per share, in the pennies range, a couple loss here and there, that's okay. Free cash flow is not supposed to be positive all the time. But here's your dollar. So if I look at this range versus this range, it's definitely growing. It's growing big. So they are able to generate cash. I think what confuses the issue is this debt financing and they're under expensing in CAPEX. Oh yeah, that's right, I didn't do that. Let me normalize that. So let's just take, just for fun, times 52. We'll make this negative. There we go. We'll zero out the debt. Now let's see, what does free cash flow look like? That's better. So now I've zeroed out debt. I've normalized the CAPEX investment for the prior years of under expensing. And what do we see? Still growth. This here is averaging, probably in a few pennies. I mean, this is a big negative. Put that aside. 10 cents a share. And then here, this is actually up nicely, 80, 23, and 67. So you're probably in the 50 cent range. So you go from 10 cents to 50 cents. It's a 5x move. Not bad, considering all this kind of machinations. If I put it all back, there, that's what it looks like now. So I think that's the point here is you need to make sure that, yes, you can use filtering, but everybody uses filtering. That's the problem. If you're using filtering to find investments and to make investments specifically in your portfolios, you need to step out and do the detailed work. That's the only way you're going to get ahead of the market because everybody is using filtering. So you have to do something that everyone's not doing. Okay, that's enough. Let's move forward. We looked at cash flow, we looked at revenue, looked at EBITDA. Let's forecast this business and figure out how much it's worth. Okay, let's forecast the EBITDA. So I've got $577 million of next year EBITDA, basically taking it and taking prior year and cutting it by 8%. When I look at their quarterly results, they're running a little behind schedule, so I'm going to annualize that, cut their earnings by 8% over the year, and I'm going to say next year they're going to be flat. They're changing CEO, they need to kind of right-size the business, they need to move, and that's going to take some time. But over long term, I think they can get back to their growth rate. Remember, the EBITDA growth rate long term was 9%. I'm saying, hey, all I need is 5% out long term. That's much different, by the way, than the 12% annual growth rate that Lululemon required. So 5% annualized growth rate. And I'm going to give that a lower 15% market multiple, not the 20 times market multiple that Lululemon had. That's going to meet $828 million of EBITDA out 10 years, which I think they can do. This athleisure area is growing. They're in a booming sector. They have a great brand name. There's value in that business. They should be able to knock out 5% annual enterprise level earnings growth. 15 times give me a $12 billion value. Debt number is not formatted right. It always bothers me. That's done. $875 is the $875 million is the format. So then you got $11 billion of actual market value divided by the shares. $24.61 is the long-term price target for Under Armour using this EBITDA value method with a simple growth, 5%, and a down year over year, a down round this year. All right, let's check free cash flow. Okay, free cash flow is the same thing. I'm going to come and pick up 68 cents. Now, I get the 68 cents by using free cash flow per share, cash flow from operations, less 52% for my CAPEX to normalize CAPEX. I'm not making any debt payments because the debt is 1.1 times, so that's fine. Then I take that number, I decrease it by 8%, and then I grow it based on that formula, and I get just shy of $1 long-term free cash flow per share at a 5% yield. Gives me a $19.64 price target out 10 years for Under Armour. So if you like this, I want to remind you, check out my website, cashflowinvestingpro.com. There's a link down below. I teach a course, I give you this Excel sheet, and I show you one-pagers, and the Cash Flow Club we'll cover later. Check out that. Yeah, shameless plug, I get it, but it comes with the territory. Here we go. Let's take a look at Under Armour. So I've got two different valuations, $19 and $24. I'm going to average it to $22. I can look in the stock market right now and get as much stock as I want at $10. Interestingly, this stock is moving around a lot. It's been as cheap as $8. We'll take a look at that in a second. So if I put this into an IRR calculation, I get my cash flow, my pro rata cash flow that I own. I'm buying it for $10. I sell it for $22. I'm making a 16% annualized return, which is a decent return. Definitely market beating. It's decent on a 5% long-term growth rate, which I really, really like. Here, if I put this into a distribution chart, it gets a little more interesting. So $10 per share is current price. It's a 16% return with a conservative 5% annual growth rate over long term. If the stock price goes up, I'm less interested. I think it's too much. But if the stock price comes down, and it's been as low as $8 recently, that's a 20% IRR. That is a very, very attractive risk-return reward. If I'm saying, hey, 5% long-term is the growth target that I need, and if the stock price is as cheap as $8, I can make 20% of my money for a decade. That's an amazing boost to the portfolio, even if it's a small allocation to it. So I think this is really interesting. It's approaching a level where it's value driven. Let's review the 5 key factors for Under Armour. Number 1, top line revenue growth. Yes, it's growing. Number 2, EBITDA. EBITDA is growing. Number 3, strong free cash flow. It's there. Number 4, low debt. Yes. Number 5, well priced. I'm gonna say yes. It is well priced because it's 16% return on a 5% growth forecast with a down year coming forward. I think it's very interesting. So I'm going to give it a good. I think it's an interesting investment. You're kind of betting on a turnaround a little bit. I would wait for the stock. If the stock comes down a little bit more, I think with this one, because of the management turnaround, because of the down round next year, There are some stumbling blocks that they need to fix, and if they do that, it could really work. And I think you give it a little bit, $8, $9 range to get a little extra kick on the return before you do it. Okay, this is Rational Investing. This has been Under Armour. If you like this style of investing, please check out my course. Cashflowinvestingpro.com is the website. Links down below, where I give you this Excel sheet. I walk you through how to read a 10K, how to read an income statement, how to read a balance sheet, how to read a cash flow statement, how to calculate shares outstanding. If this stock price splits, how do you adjust for a split? How to build a forecast? How do you find revenue, EBITDA, cash flow? How to calculate debt? And build a portfolio of 20 or so stocks that are focused, that can get you where you want to go. Definitely check out the course. If you don't want to do the work yourself, but you like the ideas, you like the style of investing, I have a club, Cash Flow Club. It's in the upper left-hand corner on the homepage of the website. Check it out. I do monthly reviews there are 10 to 12 stocks that we release every single month. Some good, some bad, but it's perspective. It'll show you a wide range over, let's say, a year of membership, a wide range of stocks, both good and bad. You get a feel for what's out there in the market. On this pager is a decade's worth of historical information, the cash flow per share, a full projection, cash flow and EBITDA projection, a graph, a summary, and the 5 key attributes summarized. You can also scroll back in time and see all the blog posts that I and the other analysts in the channel have been posting. Very, very interesting stuff. I definitely highly recommend taking a year, getting a feel for the flow of the community and specifically the breadth of stocks that we're going to cover. You will have a much broader sense of what's out there in the world to invest in. If you continue every month reading these, you'll get a feel for how good is and how bad can be. That perspective is worth a lot to you. The last thing, in the description, you can download a free one-pager. Definitely go to the Cash Flow Club, hit preview, and in the blog down below, there's a free one-page you can download. All right, this has been Rational Investing. I really appreciate the time. Thank you very much for watching this review on Under Armour as part of our Lululemon Under Armour series. Very interesting. Both companies have good and bad aspects to them. It's about how much price you're going to pay for the value of the cash flow that's there. Thank you very much. Hit the subscribe button. Hit that like button. Really appreciate it. And share it socially. I'm trying to grow the channel. That's my charge this year for something fun to do. Thank you very much. Bye-bye.